I'm Hubert Centers. Welcome to Absolute Wealth's weekly edition of Centers Strategies. Let's take a look at this week's strategy. In this week's strategy, we're going to discuss the importance of tax loss selling. Now, I'm not talking about you selling your losers this year, although it is a really good idea to cut them loose. If you've got something that is just taking a beating this year, probably not a bad idea to take the tax loss on it and start fresh next year. What we're going to talk about is we're going to talk about taking advantage of other people doing this so we can profit from the bounce. So there's a couple different theories and things that we call this. We call it tax loss selling, and we also call it the January effect. So the theory is you find a group of stocks that are trading around or near their 52-week low. And they have to be kind of high flyers over the past year, and they have to have been beaten down pretty hard. All right? So now there's a couple rules that you need to be aware of so that you don't violate a couple rules, which is very, very important. Now, you don't want to, or you can't, and a lot of people think that the rule is 30 days. It's actually 61 days, 30 days before and 30 days after. But as long as you don't go into the same security, you'll be fine. So an example, so let's say that we were long Eastman, let's say we were long Kodak all year long from up here around $5, okay? So what we would do is we would sell that at the end of December on the last trading day. And let me check the calendar for the last trading day. December the 30th would be the last day that you could do this. Obviously, you could do it sooner, but the 30th looks like it's the last day of the year this year. So if you bought Kodak up here and then you sold it down here around the 30th, you couldn't go back in Kodak for at least 30 days after you sold it, okay? Actually, 31 days. All right, let me use my pen. It looks a little bit better. But what you could do is if you sold Eastman Kodak stock, then you could buy something like INTC, Intel or Walmart or whatever you're looking at doing quicker, and you won't have to worry about the wash rule. All right, in other words, the IRS doesn't want you dumping that stock and then 5 days later jumping right back in it just for the tax loss. So just be aware of that. So what are some of the stocks and how do you find these things? Well, there's two decent resources online that you can use to make your search easier for the equities we're going to trade at the end of the year for the pop coming out of January and looking for profit. So two decent ones that I found that you can have resources online is I just searched for 52-week low or trading around a 52-week low, and two websites that popped up were bar charts and then also the NASDAQ. Now on the NASDAQ there's two different, how do you find these things? Well, there's two decent resources online that you can use to make your search easier for the equities we're going to trade at the end of the year for the pop coming out of January and looking for profit. So two decent ones that I found that you can have resources online is I just searched for 52-week low or trading around a 52-week low, and two websites that popped up were bar charts and then also the NASDAQ. Now on the NASDAQ there's two different tabs. There's a 52-week high, which is not what you want. You want NASDAQ's trading around a 52-week low, and you need to be watching these over the next 2 or 3 weeks going into the end of the year because it's going to be pretty important for the bounce. And I will include links to both of these stock charts, or bar charts I should say, and then also NASDAQ. It'll be in the article, or I'll do it in the video so that you can see it so you don't have to search for Google. So once you find these, all you're going to do is you're going to search down through these and look at some. And they have to be widely followed, like, Virgin Media looks decent. RIM, there's a good one. Very good example. RIM, Bank of America, Netflix. That's the type of things that I want you to look at to potentially buy at the end of December and hold on to it as it pops up 21 days and 31 days out into January. Now, if it turns into be a really good runner, you can hold it. If not, you're just going to flip it out for a quick profit. So let's go find some of these real quick. Okay, so what we're looking at here is we're looking at a weekly chart of RIM. And the reason we're not looking at a daily chart is because we're going to hold this thing for several weeks, at least 2 to 3 weeks, and probably even longer if it runs. So what you're looking for, once again, is a high flyer that's trading around or near a 52-week low going into the end of December. And we're going to look for a lot of people to dump it for the tax loss selling. Then once all the sellers get out of that, it's almost like it's dry kindling. And you're just going to spark or light a match and then poof, it'll ignite and pop higher. So that is the theory. And you don't want to just pick one. You want to pick a basket of 4 or 5 minimum, and if you can, get about 12 to 15, because some of them will work and some of them won't work. So this is a short list of the ones that I'm looking at so far. Rim looks really good. It's been in the news. It's obviously in trouble because of all the Apple stuff. You've had some people that were long, rim as high as, 130, 140. Now it's trading around $13. So that's a good example. Another one that's been in the media a lot, Netflix. Netflix was trading around 300. Now it's trading at 67.82. Good candidate for a jump up or a bounce for the January effect and also for the tax loss selling. Now the last two are not great examples, but if you can't afford, Netflix or RIM and stuff like that, they might be an option. I'm just putting them in my portfolio as options to kind of wait out the other. So one is Eastman Kodak. Kodak obviously is in trouble. They've been in trouble for years, but if you look at 011, not the best candidate in the world, and I'm using this as an example, but it may be a bad example in this case because it had a high of $5 and now it's trading at 77 cents. And this one's probably a better candidate for bankruptcy than it is a January effect or a bounce. Another one real quick, Bank of America, same theory. Now it was a little bit better candidate. It was trading at a high of around 15. Now it's at 5. Could bounce, but I prefer the RIM and the Netflix. So remember, when you're looking for tax loss selling and January effect, what you're looking for is something that was a high flyer in the beginning of the year or anytime during the year and is now trading at or near a 52-week low. Everybody will sell that. You'll get all the sellers out of the way, and then it'll start popping up. And then also people that were in other stocks that sell their tax loss selling will jump into these things that's been beaten down, so that'll make it pop up even more. Good luck, hope it helps, and I'll see you next week.